Hey everyone, welcome back to Corporate Decoder. Today, DWS Securities Trust just filed its N-CSRS report, and I am seeing some clear trends in their investment strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This fund is heavily invested in tech, and I want to show you exactly where that money is going and what it means for potential investors. This is a look at the DWS Science and Technology Fund, specifically covering the period from the 1st of November 2025 to the 30th of April 2026. It's a semi-annual shareholder report, which means it gives us a snapshot of the fund's performance and holdings halfway through its fiscal year. The report breaks down into different share classes like Class A, Class C, Class S, and Institutional Class. Each class has slightly different costs and features, which is pretty standard for mutual funds. For example, Class A shares might have an upfront sales fee, while Class C shares have higher ongoing costs but no upfront fee. Class S and institutional classes usually have lower fees and are aimed at specific types of investors. Let us talk about costs, because this is where investors often lose money without realizing it. The report breaks down the cost for a hypothetical $10,000 investment over the last 6 months. For Class A shares, the cost was about $44, which works out to 0.87% of the investment. That might seem small, but remember, this is annualized. It means if you keep your money in for a whole year, those costs add up. Class C shares are a bit more expensive. For that same hypothetical $10,000, the cost over the 6 months was $88 or 1.73% annualized. That's almost double the cost of Class A shares. The report notes that the gross expense ratio for Class C shares as of the latest prospectus was 1.75%. It also mentions that without waivers, costs would have been higher, so these fees could potentially increase. Class S shares, on the other hand, are much cheaper. The cost for a $10,000 investment over 6 months was just $34 or 0.66% annualized. This is significantly lower than the other classes, fitting with their target audience through specific intermediary relationships. The institutional class shares are also very cost effective, costing $34 for a 6-month period, which is the same as Class S at 0.66% annualized. This makes sense for large institutional investors who are looking to minimize fees on big investments. Despite these different share classes and their costs, the overall size of the fund is quite substantial. The total net assets are over $2.2 billion. This is a big fund, and with that much money, even small percentage differences in fees can mean millions of dollars. The fund holds only 59 different investments. This is a relatively small number, meaning the fund is quite concentrated. When a fund concentrates its investments, it means they are making big bets on a few companies. This can lead to bigger gains if those companies do well, but also bigger losses if they falter. The portfolio turnover rate is 18%. This means that within a year, the fund buys and sells about 18% of its holdings. A lower turnover rate generally suggests a more buy and hold strategy, which can sometimes lead to lower trading costs and potentially better long-term performance. It's not excessively high, indicating they are not actively trading in and out of positions too frequently. Now, let's dive into what this fund is actually investing in. This is where things get really interesting. The asset allocation shows that 100% of the fund's net assets are in common stocks. There are no investments shown in cash equivalents or other investments, and no other assets and liabilities, net. This means the fund is fully invested in stocks. There is no buffer from cash to cushion any market downturns. This is the heart of the fund's strategy. A massive 77% of the fund is invested in information technology. That is an overwhelming concentration. Within it, the biggest chunk, 38%, is in semiconductors and semiconductor equipment. Another significant part, 18%, is in software. Then you have technology, hardware, storage, and peripherals at 9%. The rest of the IT sector is split among communications equipment, its services, and electronic equipment. Beyond tech, the fund also has a notable allocation to communication services. At 15%, this includes interactive media and services, which makes up 14% of that portion. There are also smaller allocations to other sectors like industrials at 5.2%, consumer discretionary at 1.2%, healthcare at 0.9%, and financials at 0.7%. But frankly, these are minor compared to the massive bet on technology. Let's look at the top holdings. These are the companies that have the biggest impact on the fund's performance. Alphabet Incorporated Class A is the largest holding at 10.4%. That is a huge chunk of the fund in one company. Nvidia Corporation is next at 9.2%. This is a leader in AI chips and a huge player in the tech world. Broadcom Incorporated is at 8.7%. Microsoft Corporation comes in at 6.6%, Apple Incorporated is at 6.3%, Meta Platforms Incorporated is at 3.8%, Advanced Micro Devices Incorporated is also at 3.8%, Lam Research Corporation is at 2.9%, Ciena Corporation is at 2.2%. And Marvell Technology Incorporated is the 10th largest holding at 2.2%. Combined, these top 10 holdings represent 56.1% of the fund's net assets. That's a significant concentration, meaning the fund's performance is heavily tied to the success of just these few tech giants. Drilling down further into the detailed investment portfolio, we see even more specific company names. For instance, under Communication Services, we see Roblox Corporation. Under Interactive Media and Services, we have more shares of Alphabet Incorporated Class A and Class C, and Meta Platforms Incorporated. Under Semiconductors and Semiconductor Equipment, the list is extensive and full of major players like Advanced Micro Devices, Analog Devices, Applied Materials, ASML Holding, B Semiconductor Industries, Broadcom, Impinj Cala Corporation, Lam Research. Massachusetts Com Technology Solutions Holdings, Marvell Technology, Micron Technology, Nevada Idia Corporation, and Taiwan Semiconductor Manufacturing Company. This confirms the heavy focus on the semiconductor industry. Within the information technology sector, the fund holds significant positions in companies like Arista Networks, Ciena Corporation, and Motorola Solutions, which fall under communications equipment. In its services, we see names like Cloudflare, MongoDB, Shopify, and Snowflake. These are all prominent software and cloud technology companies. The software holdings are also substantial, including Aploven, Cadence Design Systems, Checkpoint Software Technologies, CrowdStrike Holdings, Dynatrace Guidewire Software, Intuit JFrog Limited, Microsoft Corporation, Oracle Corporation, Palantir Technologies, Pegasystems, ServiceNow, and Synopsys. This shows a broad commitment across various software segments. And in technology hardware, storage, and peripherals, the major holdings are Apple Incorporated, SanDisk Corporation, and Seagate Technology Holdings. This reinforces the fund's deep dive into core technology areas. Looking at the statement of assets and liabilities, the total assets are over $2.25 billion. The liabilities are relatively small, around $7.3 million. This results in net assets of over $2.24 billion. The net asset value per S-share varies by class. For Class A, it's $48.3. For Class C, it's $14.07, which is much lower given the higher inherent expenses. Class S shares are valued at $50.6, and the institutional class shares are the highest at $58.67. These differences reflect the fee structures of each class. The statement of operations for the 6 months ending the 30th of April 2026 shows investment income of about $4.4 million. However, the expenses including management fees, administration fees, and services to shareholders are much higher, totaling over $8.4 million after expense reductions. This results in a net investment loss of over $4 million. The fund did make money from its investments though. The net realized gain from investments was over $89 million, and the change in net unrealized appreciation was about $25 million, leading to a total net gain of over $114 million. This is what drove the overall increase in net assets. The statements of changes in net assets show that for the 6 months, the fund had an increase in net assets from operations of over $110 million. However, the distributions paid out to shareholders were much larger, over $164 million. This means that the fund had to sell assets to make these distributions. While distributions are good for investors, when they exceed the operational gains, it can be a sign that the fund is distributing its principal to meet these payouts. Looking at the financial highlights, the total return for Class A shares for the 6 months ended the 30th of April 2026 was 5.44%. This figure doesn't include sales charges, so the actual return for an investor buying those shares would be lower. The report indicates that not annualized for this period. The ratio of expenses for Class A shares is 0.87%, which is annualized. This aligns with the cost breakdown we saw earlier. For Class C shares, the ratio of expenses is significantly higher at 1.73% annualized. Class S and institutional class shares both have a ratio of expenses at 0.66%. Annualized, this clearly shows the cost advantage of the latter two classes. The fund operates as a single segment, meaning its management views the entire fund as one business unit. This is common for investment funds. They monitor performance through metrics like portfolio composition, total returns, and expense ratios. The fund values its investments primarily using readily available market quotations, classifying most of its common stocks as level 1 assets. This means they are valued using prices from active markets for identical securities, providing a good degree of transparency. Some international equities are adjusted using models and categorized as level 2. Interestingly, TRE is a small portion classified as level 3, which uses unobservable inputs to determine value. This often applies to less liquid or more complex investments. TRE is also an investment in Adams Capital Management LP, described as a venture capital fund. These are valued using net asset value as a practical way to estimate their worth. These investments can never be redeemed directly with the fund, meaning investors get their money back only when the venture capital fund itself liquidates its underlying assets. The fund engages in securities lending, where it lends out its securities to earn income. This is backed by collateral, often cash or government securities. As of the 30th of April, 2026, the fund had about 0.2% of its net assets out on loan, valued at around $5.9 million. The report also details the advisory agreement and fee evaluation. DWS Investment Management Americas, Inc., or DMA, acts as the advisor. The management fee is tiered, decreasing as the fund's assets grow. For the portion of assets up to $250 million, the fee is 0.48%, and it goes down to 0.32% for assets over $12.5 billion. Contractual agreements are in place to limit expenses. For Class A shares, the total annual operating expenses are capped at 1.19%. For Class C, it is 1.94%, and for Class S and institutional class, it is 0.94%. This is important because it protects investors from unexpectedly high operational costs. There was also a voluntary waiver for institutional class shares for the period, capped at 0.66%. The report shows that about $15,855 was waived or reimbursed for this class during the reporting period. This shows a commitment to keeping costs down for institutional investors. DWS Distributors, Inc., an affiliate of the advisor, receives distribution and service fees. For Class C shares, there is a distribution fee of 0.75% of net assets. For Class A and C, there is also a service fee that can be up to 0.25%. These fees help compensate the firms that sell and service these fund shares. This fund strategy is very clear, a massive bet on technology, particularly semiconductors and software. The top holdings are the biggest tech names out there. While this has likely paid off handsomely in recent years, it also means the fund is highly sensitive to any downturns in the tech sector. The concentration in just a few companies means those top holdings can make or break the fund's performance. The costs for Class A and C shares are noticeably higher than for Class S and institutional, which is a key consideration for different types of investors, the large distributions paid out exceeding the net investment income in this reporting period. Coupled with a concentrated portfolio, suggests a proactive approach to performance management, potentially returning capital to shareholders while it is high, or perhaps managing inflows and outflows through sales. For investors, the biggest risk here is sector concentration. If the tech sector faces headwinds, this fund will feel it significantly more than a more diversified fund. On the flip side, if tech continues its upward trajectory, this fund is positioned to capture those gains. The fact that the fund is actively managing its expenses and has fee waivers in place is a positive sign for cost-conscious investors. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord community linked in the description.